A lot has been made that the real estate asset class, real estate, right, is slowing down. The media made a really big deal that the prices have slowed. Well, let me tell you, they've slowed from 19% to 18.5%. There was such a slight decrease in the appreciation rate. Now, we're talking 18.5% appreciation rate. That is phenomenal. That is absolutely phenomenal. Prices are rising like crazy. Now, we talked about the fact that the stock market could be vulnerable to correction or more than a correction, and you might want to change your asset allocation to different assets. Now, real estate and cash are different assets. So real estate isn't necessarily correlated very well with the stock market. So if the stock market really takes a beating, it doesn't affect the real estate in asset class. And actually, real estate is counter-cyclical. So when stocks start to go down, real estate goes up. It's part of being a different, separate asset class. And that's just what happens. That's why sometimes it's nice to have some cash. So real estate, particularly in the big markets of the United States, Florida, Texas, and Arizona, is just going crazy. Now, there are pockets of the United States that aren't doing so well. And everyone knows what those are. California is struggling. Now, it's a great marketplace. A lot of people leaving California. $8.8 billion in tax revenue left California. So California is not going to get that money to run the state. Here in Arizona, we got over $2 billion of that. So that really helped us out. And what's going to happen, of course, in California is that they're going to have to raise taxes, which is then going to force more people out because the taxes are going to go up. And it's pushing people here to Arizona. So the big markets like Texas, Florida, and Arizona are attracting people. We're hearing people leaving Seattle. They're leaving Portland. They're leaving Chicago, leaving New York, Minnesota, Wisconsin. So they're going to these great markets, and it's really forcing prices up. And we are seeing prices rise here in Metro Phoenix like crazy. What a great market for you to be in. I'm going to have a call to action that you need to do something about this. You need to get involved, particularly if you're my age and you maybe have a little deficit in your retirement money. You may want to conservatively and make sure that we never jeopardize the asset, but this might be a really good place for you to be. We're going to talk about my real estate cycle, and I'm going to tell you that we're probably here. So this is the accumulation phase. We've been in that for the last couple of years. Really, when just as the recession was hitting and came into the first quarter of 2020, we exploded, and that would have been the accumulation phase. We're still in that, so we're still advocating that you be fairly aggressive in adding to your portfolio. Again, they always need the cash flow, and it needs to be economically make sense for you to do that. But this is in the real estate asset class. We think that we still are in the accumulation phase, and if you think prices are crazy now, wait till they get into the explosive phase, and we think that's coming. So this is the phases where you really make gains. So we'd like you to be involved. If you want to get involved, please contact us. Michael at michaeldouville.com. We're more than happy to discuss. Now, it may not work for you. That's fine. We're not advocating that you put all your money in real estate. Our cycle is showing that we still have lots of time yet. Now, as you know, I've interviewed Charles Nenner for many years. We did a live webinar last November, and he was kind enough to allow me to use this slide as a proxy for the real estate asset class. This is Toll Brothers. Now, if you follow Charles Nenner's work, it's very similar to mine. It's a cycle. So we're looking at cycles as to what one of these asset classes have a cycle. We're using Toll Brothers as a proxy. Now, this date you see up here in the upper corner is actually tomorrow. That's when they think Toll Brothers is going to bottom right here. This is the very bottom. Charles Nenner expects Toll Brothers to start to recover and start going up. Now, this is the same thing if you look at my slide. We start to see this. We start thinking maybe we're going to be heading into the explosive phase very soon, within the next 2 or 3 or 4 months. And that's going to coincide very nicely with the Charles Nenners. Now, Charles Nenner is like one of the best in the world. But this does kind of correlate a little bit and give us a little more confidence in the fact that we think my cycle chart and my model is on target. It's been on target for a long time. But again, this is a great time to talk about the fact that just because it's working now doesn't mean it's going to stay forever. So we want you always to check with your financial advisor, talk with us. But we think these charts are good, but that doesn't necessarily mean they always have to be absolutely positively 100% good. Here's some confirmation. We just literally got this from Zero Hedge. This is the housing units, and look at this. Look at this. Housing is on a tear. It just keeps going and going. These are private units. These are building permits. This is showing what's going on. And of course, this is a long-term chart, but look at how well that's doing. It's just confirming that the asset class of real estate is going to do very well. Now, there's a cycle that's showing this, and also we have a pretty big demographics at the moment where we have population shifts, and that's the why. You can see the two are kind of coming together to answer our questions, and it looks very, very promising. Now, again, these are building permits, existing homes, homes, and multi. But you can see it just keeps going up and up and up. Now, we had a little bit of slightly downturn right before Christmas. Very, very small one, and then exploded back up right along with our charts. It's giving nice confirmation to this. We think this is a very, very good indication that real estate is going to continue doing very, very well. Here we're talking about rental units, and I'm going to tell you, we are seeing more people go into rental units and not buying. And that, of course, is because some are getting priced out of the market. Here in Phoenix, it's very difficult for a first-time home buyer to buy a single-family home. So if you're a first-time home buyer and you're looking to buy VA or FHA or 3 or 5% down, and maybe your credit's not as good as it should be, you've been working on it, and you're just kind of like struggling to get in. Because remember, it's hard to get this down payment money together. You got kids, you got sports, you got car insurance to pay for, mortgages to pay for, and it takes a lot of money, and then you need to save down payment. This is sometimes a monumental task. In the meantime, a lot of people rent. Very, very good for us because we're in a rental business. It looks like there's going to be more and more people renting. I'm strongly advising, if you've got kids, if you've got grandkids, if you've got nieces and nephews, to help them buy a house. This is going to make a huge difference to them down the line. Every one of our surveys from the National Association of Realtors, they show you that those people who own their own home have 10 to 20 times the personal wealth than someone who doesn't. So this is a very, very good thing that you can help them do. And again, our charts are showing the same thing, that we're getting multifamilies coming out. We're getting some single family permits. Now, the problem with single family is a lot of the new construction is not in those big markets, and they are in Phoenix, Texas, and Florida, but that's really where the housing pressure is. We need to have more and more. They're trying, but we cannot build enough units here in Phoenix, Arizona to accommodate all the people coming in, and it is putting enormous pressure on our rents. And as the price of homes go up, price of rentals going up right at the same time, and that delta in between is our cap rate that is staying very, very consistent. So it shows to us that we have a very, very healthy market. Let me go to my next slide.